Okay, capital budgeting, CCA depreciation when the assets are sold eventually. So suppose that in our example, the assets bought at time zero for $7,500 are sold for $500 at time 4. So what happens with respect to tax regulations? The firm has to subtract the selling price, the salvage value, okay, from the asset class. So the depreciation that applies to the entire asset class will decrease. So the value of the assets to which the depreciation rate will be applied on this specific asset class will decrease by the value, by the salvage value obtained at time 4, okay, by the value, by the price we can obtain by selling the assets at time 4. So here's the example. So capex, $7,500 at time 0 minus $500 at time 4. So what does that mean, minus $500? So this is an expenditure. So minus $500 means the assets are sold. It's a negative expenditure, which means cash comes into the firm. Now we calculated here, without taking into account the sale of the asset, that the present value into perpetuity of the CCA tax shield was equal to the capex times the depreciation rate times 1 plus 1/2 the discount rate plus times the tax rate and so on, okay, into perpetuity. But this was not taking into account the impact of selling the assets for a positive price at a later date. So now we can add a third tranche to our CCA calculation. So tranche 3. Okay, so we have tranche 1, which is the first half of the asset depreciating at a rate of 45%, starting in year 1. The second tranche of CCA, which is the second half of the capital expenditure, depreciating at the rate 45%, beginning in year 2. Now, if the assets are sold at the end of year 4, there are going to be depreciation consequences in year 5. Okay, so when the assets are sold in this chapter, we assume they are sold on December 31st. So if I say assets are sold in year 12, that means they are sold on December 31st of year 12. So the depreciation impact of the sale of the asset will take place in the following year. So here we have to reduce the value of this pool of assets by $500. So we applied 45% to 343 in the first tranche. We applied 45% to 624 in the second tranche. So that gave us a depreciation of 154 here, 281 here. But then this entire asset class will be reduced by $500. So here we applied 45% to a total of $967. But in fact, we should have applied it to $467 because we need to subtract the value of the entire asset class by the price at which the assets have been sold. So here there's a second tranche which will be negative. So it begins with minus 500, so minus the salvage value. We apply 45%, so this entire depreciation here of 154 plus 281 has to be reduced by 225, which gives 210. 210 instead of 435. So by taking into account the sale of the asset, the tax shield is reduced. And we keep going. So the minus $500, it's the same thing as the two others. It's a perpetuity with a growth rate with a first payment of minus 500 and a growth rate of 45%. So the first payment takes place at time 5. So the present value that we calculate with the perpetuity formula gives us a present value as of time 4. So minus 500 times 45%, which is the first payment here, minus 225, is the first payment received of this perpetuity as of time 5. So divided by R minus the growth rate. So the growth rate is minus 45%. So minus is plus. So that gives us the present value of the depreciation we will never able to be used from because the assets are sold for $500 as of time 4. Okay, so look at this equation here. So minus 500 times 45 over R plus 45%. So this is the present value as of time 4 because the first payment of the third tranche of CCA depreciation takes place at time 5. If we want to compute the present value of the third tranche of depreciation as of time 0, we need to discount the present value of this perpetuity over 4 years. So we need to divide what we obtained earlier here by 1 plus R to the power 4. And what interests us is the tax shield. So we need to multiply this value by the tax rate. So taking into account the sale of the asset for $500 at time 4, so the present value of the CCA tax shield in our example is the present value of all the depreciation when the assets are used, minus all the depreciation we will not be able to claim because the assets have been sold for a certain amount. Okay, and more generally, so the sum of all 3 tranches of CCA depreciation tax shield gives us the present value of the CCA tax shield, which is the CCA tax shield, assuming the assets are kept forever, minus the CCA tax shield that will never be collected because the assets will be sold at a price S at time T. And next, we will go over an example.